to materially improve patient outcomes. And I don't have the numbers off the top of my head, but you've got obesity is a global issue, and certainly in the US. So the ability to change the path, or at least meaningfully change the life expectancy and the mobility, and has really big impacts going forward, both for healthcare itself in terms of managing the costs that come from obesity, but also, as you touch on, other areas like retail spending and food consumption and types of food consumption. So this year has seen very strong performance from names that are positively associated with that. In general, they've been up about 45%. You've seen names which are negatively associated with that, things like dialysis businesses and those sorts of ones that treat the symptoms of obesity or related to obesity, have been particularly hard hit. Arguably, we'd be of the view that I think this is a long-term cycle, and it is a market which will continue to grow. So those that are positively affected by it will continue to benefit. Those that are negatively affected have probably been too negatively affected at this point. So I think, as an example, the dialysis businesses have been impacted because their expectation is that the demand won't be there. Inversely, you could say if people are living longer, they're probably still going to have kidney and liver-related issues going forward, so their demand will be there over time.
Just delayed, perhaps.
Exactly.
Okay, so we've touched on the broader economy, we've touched on shares, and we've touched on bonds at a sort of a high level. Is there anything in the bond space that you feel needs to be called out? How have they compared with the returns that shares have offered over the year?
Well, I think, look, the simple fact is we have seen, maybe it's not just this year, but we've seen a tectonic shift in terms of where the bond market was in 2020 and 21, back to a level where these are basically the cheapest all-in returns you can get, or yields you can get out of bonds that we've seen broadly in 20 years. And I think that's really exciting, actually, for investors, because it means that your typical balanced portfolio, which all of our clients, or most of our clients, will have an exposure predominantly to shares, but also to bonds to provide some stability within the portfolio and to provide that running yield. For the first time in many years, that provides a real opportunity and a real return driver for the portfolio. So I think that is the biggest issue that we've in terms of bonds, is just once again they have a real place within portfolios after being a bit of a challenge for really the better part of 5 or 6 years coming into even pre-COVID. So that's the opportunity set. And if you look back at something like high yield bonds in the US, they've performed really well over the last sort of 6 or 8 weeks as share markets have moved up, but you're still getting a starting yield of 8.5% from those securities. That goes a long way in terms of return, in terms of your annual return target. So I think from in terms of looking forward, it actually makes us very positive about the world ahead, because you have return coming from multiple sources.
Yeah, and there's always this tension where, particularly at the start of the year, where volatility was a bit higher and cash was returning reasonably well. And 2022 particularly been a really difficult year for bonds, that investors move to cash and then don't benefit from what shares or bonds have to offer over the longer run. And what you can see now is that both those asset classes, if you take a longer view, in this case just 1 year actually, but obviously a much longer view is better, will deliver over the long run.
Yeah, I think there was an interesting article in the Wall Street Journal about a month ago that sort of talked about the hottest asset class in America, and basically it had been cash. and which is really unusual. Usually the hot new thing is something, new and sexy and quite risky, probably. And arguably, at this point, for those who have a long investment horizon, those who are younger, cash is pretty risky. It is probably about as good as it gets at the moment. Central banks are getting to the end of their raising cycle. Cash yields are expected to move lower. That'll support other asset classes by definition. So it should be good for bonds. It should be good for shares. And by definition, if central banks are cutting interest rates, returns on cash investments will be lower. So therefore, useful maybe for a very short period of time, or if you do have spending needs and needs that you need over the short horizon. But for anything longer, it's about, and we'd always be proponents, and the advisors would say it's about moving up the risk spectrum, taking advantage of the opportunities, especially the opportunities that they're now in bonds and the opportunities that they're there in shares, because we've had a difficult couple of years and valuations are pretty attractive.
One of the things that regular listeners of the Monday Call will know is that NZ Funds has a wedge of crypto in its growth category, and we were early to adopt this, and we manage it as a little addition to the core of the portfolio, which is shares. And crypto's had a very strong year. Take us through what's driven that, and particularly over the last few months, it feels, or there has been a lot of activity in that space.
Yeah, definitely. I might go back a little bit and just sort of think about how do we, or let's try and explain how we think about crypto assets. And I think there are probably two things there. One, if we look back through time, I probably compare a lot of things that with something like Bitcoin or Ethereum to the internet, in the sense that you had naturally, when something new comes on the market, or something new is available, you get this period of hype. And certainly you had that during the dot-com boom with the internet, early 2000, 99, 2000, 2001, massive valuations for anything with dot-com. And then you had a fairly spectacular bust. But clearly out of that come the Amazons, come the Apples and other businesses, and lots of businesses that didn't exist previously. Is crypto as big a deal as the internet? Probably not, but we do think it is important, and it has some important technology behind it. And for that reason, we had that sort of boom in the hype period post-COVID, and we've very much sort of seen that, saw that decline last year where Bitcoin dropped from 70,000 to sort of, was it 12 or 13? I can't remember at the low. But our view was, we needed to continue to be watchful, and much like that period post 2000 in the dot-com, those assets, there were assets there that we weren't sure which ones were going to do well, but we knew, or we expected, that there would be assets in that space that continued to thrive because there is a purpose and a point of it longer term. I think what is interesting in terms of Bitcoin and Ether being the main two, and that's very much our focus, not little if no focus on other coins. But what has been interesting is you've seen a change in correlations over the last sort of 12 months since the lows, in that Bitcoin especially, and Ethereum as well, have tended to be more correlated with gold. And theoretically, gold is a store of value because it's relatively hard to source. The supply of gold is relatively finite. Bitcoin, by definition, there are 19.5 million Bitcoins created, and there are going to be no more created. There are still some being mined to get to that 19.5 million, but at that point, that stops. So from a theoretical standpoint, it should have characteristics more similar to gold in the sense that supply is fixed. And during the hype period, very little correlation to gold. But more recently, correlation has been much, much stronger. And, we recently saw in the last 2 weeks, gold hit an all-time high. And likewise, we've seen Bitcoin and Ethereum perform very well this year. In fact, Bitcoin is arguably the best performing asset class this year, up sort of 164% from the start of the year. Ether a little less, but up sort of broadly 95, 96%. So within our portfolios, we, very much the split of the three growth portfolios. We have the New Zealand and Australian assets, which are broadly a third of people's investments. That's a research-driven portfolio of New Zealand and Australian shares. We have the global shares portfolio, and that is predominantly externally managed by our two external managers, Fisher Investments out of California and MFS out of Boston. And then we have the global macro portfolio, which is half invested in shares, and that really looks to use other assets to provide a growth return, but not purely shares, create some more diversification to portfolios. So, that, as I've touched on, you've got assets like high yield, which are really attractive at the moment. You're generating growth-like returns from those assets. And certainly Bitcoin and gold, and as part of the commodity exposure, have a role to play there. So we have a position, and that is actually really benefited portfolios over the year.
Yeah, and it acts as a genuine diversifier.
Correct.
In a way that perhaps it didn't as much as it sort of correlated more with share markets in the earlier days.
That's why I did want to focus on that correlation issue, because it was very much an uber risk asset post-COVID. When shares went up, Bitcoin went up. When shares went down, Bitcoin went down. Now it is starting to behave more like a precious metal ultimately.
Fantastic. Okay, so in our year in review, the only one sort of major asset class we haven't touched on now is currency. Take us through that and the big shifts there. You mentioned Japan a little bit earlier, but there have been some other big moves along the way.
Yeah. I'll probably simplify it down to one thing, the US dollar. And when US interest rates are high and amongst the highest in the world, the US dollar is strong. And that's very much the story that we saw last year, and really has actually still been the story this year. And generally, the US dollar has, certainly because interest rates in the US continued to, up until about 6 weeks ago, move higher, the dollar continued to be strong. And certainly against Kiwi, we're sitting here at sort of 61 cents to the US dollar at the moment. We started the year at 63.5, so we are lower. And we have seen periods, I think we were down as a low of 58. So, sort of a decent sort of 10% move lower over the year. Other ones that have definitely moved lower are China, as you would expect. Weak economy, falling interest rates there, and really that interest rate differential versus the US becoming quite large. So China has been weak. Touched on Japan, zero interest rates there, 5.5% interest rates in the US. Definitely been, Japanese yen weakness, US dollar strength. So that is I suppose one of the interesting questions as we enter the next year is, you've had this period of really 2 to 3 years of US dollar dominance and strength. That's probably likely to change in an environment where the US inflation is behaving and interest rate cuts are becoming more likely. We would expect the US dollar to generally be weaker. Locally here, we'd like to think local aspects have an impact. Certainly, interest rates here do, but actually a lot of it really comes back to what is the path of US interest rates. If they are falling, the New Zealand dollar tends to do well. And, put it another way, the New Zealand dollar tends to follow risk assets. So if share markets globally are moving higher, New Zealand dollar tends to do better.
Yeah, okay. All right, well, now let's put a line in the sand and say, okay, that was the year in review, and we're looking now forward. Obviously, there's a little bit in there on currency, but where do you, from here, see the big-ticket items, rates, inflation, heading? And, what are the big risks in that space you see? Because, well, let's face it, we haven't been great at predicting the path for inflation over the last sort of 3-4 years. I mean, as economists worldwide, I think it's fair to say. And, although, at NZ Funds, we've, had some good runs on the board there, but it is a very, very difficult area to take a strong view on. So where do you at this point see inflation heading, and how are you thinking about protecting the portfolios and exploiting the opportunities as they come through?
Yep. Inflation, I think, as I said at the start, globally has really surprised in terms of areas where it went up quickly. It's also come down quickly. And if we think about the concerns that central banks have, it's really about inflation expectations becoming embedded, and it becoming embedded in things like wage agreements. Globally, that hasn't happened. So the path there, I think, actually looks quite strong. The biggest challenge might be that last mile, as always, just proves to be more challenging than what people expect. And that comes back to you still have some of the factors around, like government spending, the move to decarbonise economies, and the reshoring of assets back to home countries are all costs to the economy. So from that aspect, that I think you'll get concerns, maybe episodic concerns over the next year that inflation is initially under control, then it's coming back and not, and it may be a sort of a back and forward. But I think the big stepping back, generally we're on a path back towards the target for central banks, and it'll be more fine-tuning rather than anything else. And I think, likewise in New Zealand, we saw the Reserve Bank a couple of weeks ago be quite hawkish and concerned about the outlook for that inflation may continue or wasn't coming down as fast as they would like it to be. I think very much that is round that fine-tuning, that inflation is coming down in New Zealand. We know that. It's probably likely that we'll have a 4 on the front of inflation come the end of the year, once the fourth quarter inflation number is released. And in light of 2% population growth, that's a pretty good outcome, really. So still sort of see that as being fine-tuning. I think the simple mantra for anything within the fixed income space, government bonds, corporate bonds, etc., is at these levels you just got to own them. The risk reward of you getting paid the highest levels you have in 20 years, you need to own them. And there will, again, there may be some challenges over the year ahead, but from our point of view, that initial yield of 5%, etc., or plus makes up for a lot of sins. And with the real potential that if inflation behaves, interest rates come down, they get a real boost in terms of their return from that decline in interest rates. And we definitely saw that back in October, with the bond portfolios doing sort of, somewhere between sort of 2.5% and 5.5% in a 1 month period. So you're really almost getting towards a full year's cash return in 1 month. So that, I think from that point, that's, it's a pretty positive outlook.
Right. And so within the shares category, valuations look a lot more attractive than they did a year and a half ago, or what have you. And there's, and it's, buoyed by strong global growth numbers still flowing through, plus, themes like AI and healthcare and so forth. How do you sort of see the mix within, global shares versus Australasian shares on the one hand, and then you've got your kind of your tech versus old world versus small caps, and the opportunity to be in each of those different areas as an active manager?
Yeah. I think probably starting with tech. Tech has been exceptional, I think is the right word. If we go back and look at their earnings compound growth rates since 2013, the Magnificent Seven, to sort of focus on that group, have grown earnings at 15% per annum continuously over the last 10 years. That is a remarkable number. And, really does explain why they dominate the market so much. Real question is, that's probably in the price. The expectation for the next 3 years is now that they continue to grow at 20% per annum. That's possible, but that is the expectation. So, not so. We definitely still think tech has potential, but at the margin, we are of the view that we need to, you need to rebalance portfolios, and tech can't continue to do that. If we look at the broader S&P outside those names, that historically has grown over the last 10 years at about 6% compound growth rates. Expectations, are for much the same over the next 3 years, so for about sort of 6 to 7%. In an environment where inflation is, a little bit higher than what it's been, that seems fairly fair valuation. I think again, one of the things we've seen is that outperformance of tech versus more of the broad market, as I touched on, was really one of the themes this year. And if we look at the sort of the extent of that, something versus, say, the Russell Index, small caps, the NASDAQ Technology Index has outperformed that at the moment by about 30% on a 12-month basis. That is one of the largest annual differences we've seen. They have been much bigger in the 2000.com era. That was 100% difference. But generally in that sort of 30 to 40% range is where it gets pretty stretched. And we would expect and are certainly positioning portfolios to have a more broad-based exposure over the year ahead. So more exposure to small caps, more exposure to economically sensitive businesses, potentially even some more exposure to emerging markets for that similar reason. Domestically, New Zealand is still, I suppose, a challenging outlook. From a valuation perspective, it's a little still recovering. It got very, very expensive. It's still slightly more expensive than the average. Whereas you compare that to international markets, and they are outside of the Super 7. They are pretty cheap. Valuations are below historical averages. In New Zealand, we are ultimately quite a GDP-sensitive market, mature market, but it hasn't gone up for 4 years. And I think for that reason, it's hard to point to the catalyst, but I think there is actually potential that New Zealand could be a surprise when we sit here this time next year, that actually New Zealand shares have ended up performing much better than even we would have expected. But again, within the share space, much like the mantra for the bond space, we think you're being paid to own them, and you want to be fully invested. In fact, key for going forward into next year is we want to actually be slightly over-invested to take advantage of this positioning of valuation in terms of markets and the potential for interest rates to come down and really create a positive market outcome for 2024.
And within the share category, there's always this sort of concern around credit stress somehow coming through and that being expressed in the share prices and so forth. How do you see that higher interest rates tend to historically lead to some companies really struggling and others obviously finding their feet, and it's a platform for the next phase? Does that concern you, or do you think that's under control?
I think it's something to be watched, but again, looking at, and I'll be honest, this is something as a bond person, and early in my career, I never really understood about share markets, is especially in terms of the headline share markets, the fundamental credit quality of those businesses is extremely excellent. I don't know if that's the right word, but they are extreme. These businesses generally have very little debt. They have massive ability to fund themselves either through cash flow or raising capital on the market, etc. So chance of them being stressed is very small. As you move to the smaller cap businesses, that becomes more of a challenge. But generally, this has been a point where many businesses have actually funded quite long term, and they've got an ability they've had an ability to work through that process. There will be stress at the margin, but certainly, of the view that that's not going to be an issue for the share markets. Might be for parts of the credit market, some of the high yield market, maybe some some of the leverage loan space or private lending, which we're not active in, potentially has more issues there. But nothing that would generally leverage levels are pretty low, and companies have been good at earning strong margins. So in that environment, that seems like, again, a sort of a 94, 95 sort of semi-Goldilocks environment that we're heading into.
Okay, and so in the commodities and currencies space, how do you see that playing out over the next year?
Commodities have been something we haven't talked about. It's been a really challenged space this year. We talked about oil, starting the year at $77, has been up to sort of $90, $70 here today. The low's been at 65. Most commodities have struggled this year. And, that is even in an environment where actually, US growth has been better. And a lot of that, I think, ultimately is the fact that Chinese growth, so much of activity has happened in China over the last sort of decade, and Chinese growth has been very muted. And in many respects, given the nature of what is happening in China, there is a fair chance that China continues to be very muted going forward. We saw in the US post the GFC, that was a banking and property crisis. In many respects, China is facing the same issues in terms of their property market that is, not sure oversupplied, but certainly needs to continue to correct. And there is a question over the degree of bad debts within the banking system related to that property market. So that needs to work through, and as a result, sort of people's ability or desire to borrow, and actually their ability to access borrowing, much like it was in the US post the GFC, becomes pretty constrained. So from that point of view, China continue to be muted. That's probably going to weigh on, especially some of the industrial commodities, things like copper and that nature, and maybe iron ore. On the flip side, precious metals, gold, silver, Bitcoin, and actually we need to come back to that, are definitely in an environment where interest rates probably are likely to continue to fall, are supported. I didn't come back to your question earlier about Bitcoin in terms of what's on the horizon there. I think, again, it's one of our focuses is the regulation for Bitcoin is a positive. As we move forward, that will, it will become more regulated, and it becomes more of a normal asset the more it becomes regulated. We're likely to see quite shortly that the US will approve the first sort of spot Bitcoin ETF. BlackRock, the world's largest asset manager, wants to launch one. That will allow many investors who have never looked to invest in Bitcoin previously buy it as they would buy any share. And certainly when the ETF on gold, GLD, was launched many years ago, that brought a lot of new investors into that space. So we would see it as being positive that it broadens that environment and actually creates sort of, there's some latent demand there which hasn't been there previously.
Very good. So when we think about client portfolios and looking forward, so there's, our client portfolios are made up really of sort of three main categories plus cash. You've got your income category, which is there to drive, as a diversifier and drive more steady returns through time. We have the inflation category, which looks to protect clients' purchasing power through time, and they tend to be invested in a very diversified range of defensive shares across property companies, infrastructure, and so on. And then we have our growth category, and so that's been set up for clients to be able to deliver over the longer term, generally a minimum suggested investment time horizon of 10 years, which, for KiwiSaver investors and most investors looking to build wealth or manage wealth through their retirement, for example, is right. So you mentioned there's a little bit of leverage in there. So we've overweight more generally in the growth category. You also mentioned that we have, in the past we've had a technology overweight, but we're careful about that at the moment.
Diversified exposure.
Diversifying that across. We have MFS and Fisher, and they plus a little bit of active management from us in our global shares portfolio, and so that's really to drive access to those large global shares, and we're really confident in the quality of those managers. And then lastly, there's the crypto wedge, which acts as a true diversifier, increasingly so, and is there to deliver a diversified or a growth addition to that portfolio. And in in our active series suite of investments, the crypto sits within our global macro portfolio, but also our KiwiSaver and other investors, it sits within the growth category. Is there anything else in there sort of there for investors that you want to flag about how the portfolios are set up for the new year at this point?
Probably the one I haven't talked about is that inflation space. So very much that sort of middle category for us that is very much dominated by what is focused on essentially three sectors: property, and in New Zealand's case, retirement villages, utilities, and infrastructure. And those industries, those sectors, are very real asset heavy, and they have an ability to grow. They're quite stable cash flows, but grow their stable cash flows over time. And it's fair to say that in an environment where short-term interest rates have been rising, that's actually a space that's been really challenged and struggled this year. And certainly, if we look at, say, something like utilities in the US, that's one of the the lowest performing sectors. And if we look forward, in an environment where interest rates are peaking and likely coming down, that should be very supportive of that space. So, and valuations are low across that space. They're really being compressed and continue to be compressed by interest rates. So I think that is a space where might be the quiet achiever is probably the right way to put it. That, certainly property in the US is not expensive. In New Zealand, property potentially still more expensive, but things like retirement villages have some real upside potential, we think. Looking at the utility and infrastructure space, again, challenged by interest rates, but definitely becomes a more attractive space as we go forward that will benefit both from being able to grow their earnings if we see growth in global economies. Also, relative valuation of interest rates are falling. They are bond substitutes, so they become more attractive. So I think that's the space to call out as being, in some respects, maybe the forgotten space, but actually one which this year we would expect to do really well.
And if inflation numbers continue to, stay elevated, that's the space in which they can pass on the cost to consumers, more easily than other businesses might be able to.
Yeah.
And in the New Zealand context, if we're getting 2% population growth, there's no shortage of demand for power companies and other utilities. So
exactly.
It's a great place to be.
Yeah.
Okay, Mark, I think that we're going to wrap it up here. Thank you so much for today and for the many times you've been on the call this year. Now that we enter the silly season, it's sort of been really helpful learning about how the portfolios are set up, and I hope clients and advisors and accountants with whom we work have benefited from our conversations. So everyone, we look forward to seeing you again next year, and have a great Christmas and a great Christmas break.
Merry Christmas, everyone.